Buy down interest rate. Buying down an interest rate, also known as buying points or paying for a lower rate, is a strategy used in mortgages and loans to reduce the interest rate over the life of the loan. By paying extra upfront costs or points, you can lower your monthly payments and the total interest paid over time. This method is commonly used for mortgages, but it can also apply to other types of loans. 1. Understand what buying down means. Points. 1 point equals 1% of the loan amount. For example, on a $200,000 mortgage, 1 point would cost $2,000. Interest rate reduction. Typically, each point purchased can reduce the interest rate by about 0.25%, but this can vary by lender and loan type. 2. Determine if it's worth it. Buying down your interest rate is an upfront cost that can be beneficial if you plan to stay in your home or keep the loan for a long time. It's especially useful if you can afford the upfront cost. You plan to hold the loan for several years and will save more on interest than you spend upfront. 3. Calculate the cost versus savings. Short-term versus long-term. Determine how much you will save monthly on your payments and calculate how long it will take for the savings to exceed the initial costs. Break-even point. Calculate how long it will take to recover the cost of the points through the savings from the reduced interest rate. For example, if you pay $3,000 upfront and save $100 per month, it would take 30 months to break even. 4. Talk to your lender. Before making any decisions, ask the lender how much each point costs and how much it will reduce your interest rate. Ensure that buying points is an option for the type of loan you're applying for. 5. Compare different loan options. If you can afford to pay for points, compare the cost and benefit with other loan options. No points loan. Sometimes a loan with a slightly higher interest rate but no upfront costs might be more beneficial if you plan to sell or refinance before reaching the break-even point. Adjustable versus fixed rate loans. Consider how buying down points works with different types of loans, such as fixed rate loans versus adjustable rate mortgages, ARMs. 6. Check for other fees or costs. While buying down the interest rate can help reduce your monthly payments, ensure there are no hidden fees or conditions that could diminish the benefits, such as high application fees, closing costs, or other upfront charges. Buying down your interest rate is an effective way to save money in the long run, especially if you're planning to hold the loan for a long time. It's important to evaluate the upfront cost against the long-term savings and determine whether it fits your financial goals and situation. Always compare various loan options and consult with your lender to make an informed decision.